In this video we're talking about how to pick the best growth stocks for your growth portfolio. So by following these rules you can pick fantastic growth stocks that are going to continue to grow at an impressive rate for years and decades to come. Don't be afraid of rebalancing though if a stock that is supposed to be growing slows down, and also usually in these sorts of portfolios the dividend is sacrificed in terms of the money is reinvested into growth, so don't expect dividends from most growth stocks. If that sounds like something you're interested in today, do please smash that like button, consider subscribing to my channel, and I'll see you in there and explain just what rules can be used to get the best growth stocks into your portfolio. Welcome into the video guys. So the first thing you want to be looking at is strong customer loyalty to the brand or the company and the stock that you are looking at. So reoccurring revenue that appears month after month, year over year, comes from very loyal customers. There should also be a strategy to sustain and grow market share for the company going forward, and customer relationship management is also vitally important. What they want to do is create a revenue loop that brings the customers back for more each and every time. The next thing you're looking at is the company that you're looking at a valuable brand or trademark, and do they have a news pipeline of what is up and coming for this company? Now you can get at this through SEC filings on the website, digging in and around other investing applications such as Market Watch, and find out just how good this company is at putting out publications as to what it's doing, because that usually, along with great revenue, kicks up the share price. Also, are there any institutional or well-known investors getting on board, such as Cathie Wood and the like? Essentially, recently Cathie Wood jumping into companies like Tesla or Palantir has caused stock prices to tick upwards. Is the product a niche product or service? Is the product new and innovative? Can it be copied easily? And are there competitors out there that are looking to compete with this? That will obviously hamper growth if they have a product that can easily be copied or is not patented. Is there more room to grow? Is the company operating in a sector that has more space to grow? So can the growth be sustained over the longer term? Because that is what you're looking for. You're looking for the growth to continue over the coming years, not just months. So can this be sustained? Are they the first mover in their sector? Are they the first company to be offering that price or offering that product or service? Because this would give them a significant advantage. You're also looking at whether the product or service can be patented. Is it patented? And what competitors do they have, whether they're small competitors or large competitors? You're also looking at whether the company has a moat. If a company has a moat in terms of different ways, that means that it has essentially a competitive advantage over its rivals, that it can offer this product better. For an example, I know Coca-Cola is a dividend paying company, but Coca-Cola's brand moat is absolutely huge. Whenever anybody thinks of Coca-Cola, they automatically think of the company Coca-Cola, not the drink that can be provided by multiple different brands. They always think of the red that is Coca-Cola, and that is the sort of thing that you're looking at in terms of social media for Facebook as well, for example. Now looking into the actual fundamentals, you're looking to see what PE ratios are around. Now a high PE ratio does suggest that the company has got growth expected of it. So a price to earnings ratio values the company that measures current share price relative to its actual earnings. So if the company is front loaded essentially and there's a lot of value in the share price, you can almost bet your bottom dollar that investors have already jumped into this one based on the future revenue that it could provide. So this is a high PE ratio, is usually an indicator of either a growth stock, but also you need to be careful because it can also indicate obviously that a stock is overvalued. So you need to be very careful with how you use that sort of ratio. There is small risk if the growth is not a small risk here if the growth is not realised, because essentially the company is just overvalued and then the share price can come down. The company needs to have the fundamentals in revenue growth and the like to continue that upward trend in the share price. They need to have a strong compound annual growth rate. So looking back over the previous year's performance, I know past performance isn't always an indicator of future performance, but it gives us an idea of the history. You want to see the chart essentially going up in a lovely curve like that, and the revenue doesn't necessarily need to double each year, but it does need to be growing at a really good rate. So a minimum of 20% year on year is preferable, but doesn't necessarily have to go. Double digits is a bare minimum for a growth company in my opinion, but for a lot of people 20% is the bare minimum. So it's an accurate way to determine the returns on a company over time. Investors can compare the compound annual growth rate of numerous companies and see which one is growing at a faster rate and maybe a more sustainable rate as well. There'll be an above average EPS, so earnings per share is a company's profit divided by the outstanding shares of common stock. The resulting number indicates the company's profitability. The higher the EPS, the more profitable a company is considered to be. So you're looking for this to be as high as possible, and that is an indicator just how much money this company is turning over and making in profit essentially. So you want that to be high in your growth stock because that needs to be sustained over time, and it's a good metric to keep an eye on over the years and months ahead to make sure that it's still riding the wave of growth. Above average profits goes without saying really, so this is essentially the metric that's left over once costs are deducted from revenue. So this is the amount that they've got left over. They should be making profit. Some debt and some loss is okay right at the start, but when a company starts growing and it's riding that wave, essentially profit should be generated all the way. And I know there's companies out there a little bit like Tesla that reinvest most of that profit, so they don't actually make a great deal, but that is all reinvested into growth, and that is still essentially driving the share price upwards, which we have seen massively. Should also be a very high return on invested capital. So this is how well a company does at turning capital under its control into profit. Return on capital invested ratio gives a sense of how well the company turns its money into profit and reinvest that money. It's a very good indicator of just how good the management of the company are in terms of taking that holistic nature of all of the company's resources, be that human, be that raw material, whatever that is, and turning that into product at the end of the day and doing it in an efficient manner. Excessive debt is a big one. You do not want the company to have excessive debt. It can have some debt. Most companies do have debt in some sort of way, but you need to be very careful of the debt burden so they're not getting into too much debt, and it needs to be very well covered by the revenue that they are generating at the bare minimum. Too high a debt load will essentially damage the growth of the company eventually, because they'll be too busy trying to cover the debt instead of investing in growth and research and development. You must allow time to play its part in your growth investing. Companies don't just double in value overnight. You need to allow the business to grow, and growing a business takes time. It's not always an easy road either. Establishing revenue streams and reoccurring customers takes time, and it has to be built over time. It's as simple as that. I keep saying time, but that is all you do. You do your research, you put your money in, and then you sit back. Don't be tempted to tinker with it or take your money out and try and crash it here, there and everywhere. Just pick a good company, do your research like this, and sit back and watch. Compounding, even in the business world, takes time, and you just have to be patient. Have a long investing horizon of at least 5 years, guys. A minimum of 5 years when you're looking to seriously grow your money. Lastly, you need to know your exit strategy. So what price target are you aiming for with this company, or are you just in it for the long term? Is there any sort of indicator that you will jump out at, if they slow down, if those ratios that I've already indicated start to slow down and the company starts to camber out and flatten off, are you going to move your money elsewhere? What price target are you going to use for that? And then where are you going to transfer your funds to and rebalance to sustain that growth that you're looking for? Be prepared to cut losses if needed. If there is a fundamental change within the business or there's a PR disaster, then you may need to cut out and reuse that money elsewhere instead of holding firm. If you are super confident in the company, then by all means average down and wait for it to come back up. But you need to obviously carry out your due diligence and your research to be confident of that. Hopefully by using these rules indicated today, you can use them to eliminate a vast amount of stocks from your due diligence and only concentrate on focusing in your research on some proper ones that might actually make it over the threshold into your portfolio. You don't have to use every rule to within an inch of its life, but they're just there that will essentially sort the wheat from the chaff and give you some hopefully really good companies going forward, because you are looking to sustain this growth. You're not looking for the growth just to be over 6 months. If you're going to leave your money in for the long term, you want them to continue growing over years and years to come. I hope this video has helped you a lot, guys, and if you could consider smashing that like button and subscribing to my channel, that would be absolutely amazing. And hopefully I'll see you later on in another investing episode. Catch you later.